Traders lose because they're waiting for the wrong thing. They watch charts for hours, hoping a reversal appears, convinced that patience alone is the virtue that separates winners from losers. They don't realize the professionals aren't looking for reversal, they're looking for confirmation in a 4-bar window. Jesse Livermore called this the pivotal point, and it became the decoder that transformed his speculation into mechanized, repeatable edge. Today, you're about to learn the exact framework that separates those who scalp panic from those who ride real momentum, the kind that moves not cents but dollars, not ticks but real conviction. The cost of misunderstanding this rule? 90% of your capital wiped in a single losing streak, the kind that forces traders out of the market permanently, broken not just financially but psychologically. Amateur traders confuse patience with paralysis. They sit on the sidelines, telling themselves they're waiting for setup, when in reality they're paralyzed by fear, checking charts obsessively, searching for the perfect entry that never comes because they don't know what perfection looks like. Professional traders know a secret that amateurs refuse to accept. Waiting is a position. Waiting with conviction, waiting with rules. Waiting isn't absence of action. It's the most disciplined form of action there is. The next chapters will expose how Livermore used a 4-bar lens to trigger decisions so fast, so clean, that amateurs thought he was simply guessing, that he had some mystical intuition or inside information that gave him edges they couldn't replicate. He wasn't guessing. He was reading tape. He was reading the conversation between buyers and sellers, interpreting volume and price action, the way a musician reads a score, and in exactly the sequence that follows, you'll understand the decoder he built from decades of watching markets like a hunter watches prey. But first, you need to know why 4 bars matter more than any indicator on your screen, more than moving averages, more than stochastic oscillators, more than the Fibonacci ratios you've memorized or the support and resistance levels you've drawn. The answer will change how you interpret price action forever, because it will shift your focus from predicting what comes next to observing what's already happened with absolute clarity. This opening chapter establishes the fundamental identity divide that runs through every trade, every decision, every moment you sit in front of a screen. The amateur is waiting without rules, hoping without structure, trading based on how he feels rather than what the tape is saying. The professional is waiting with confirmation, operating from a codified framework that turns subjective decisions into objective mechanics. This distinction isn't philosophical. It's the difference between accounts that survive crashes and accounts that evaporate in single drawdowns. The central mystery that will carry you through this entire video is simple but profound. Why did Livermore choose 4 bars, specifically, as his decision window when he could have chosen 3 or 5 or 10? Why 4? What makes that time frame the precise moment when noise transforms into signal, when hope transforms into probability, when amateur desperation transforms into professional conviction? The hints are everywhere in his writings, scattered through market memoirs, buried in the tape he spent his entire life reading. The answer lies not in indicators or oscillators, but in understanding how markets actually move, how real money actually accumulates, how real conviction actually prints on a chart. It lies in reading the tape itself, in watching the sequence of price bars unfold, and learning to interpret what each bar whispers about the state of control between buyer and seller. This is what separates the traders who make money consistently from those who lurch between lucky wins and catastrophic losses. The chapter closes with a promise that understanding the 4-bar window will reshape how traders interpret price action, because once you see the pattern, you can never unsee it. You'll look at any chart, in any time frame, in any market, and the 4-bar confirmation will jump out at you like a neon sign. You'll start noticing that every significant move in any instrument, stocks, futures, crypto, forex, tends to print this pattern first, tends to telegraph its intention through these 4 specific candles before the real acceleration happens. This observation isn't coincidence. It's not luck. It's mechanical. It's the way price acknowledges that control has shifted, that conviction is built, that the early movers have been rewarded, and new participants are piling in. Once you see it, every trade becomes a story with a beginning, middle, and end. Every setup becomes testable. Every entry becomes mechanical rather than emotional. Every exit becomes based on whether the pattern still exists, rather than whether you feel good about it. This seeding of curiosity propels the viewer forward because the promise is concrete. You will see charts differently after this. You will have a lens that works. You will have rules that function independently of how you're feeling. independently of what the market news cycle is screaming, independently of whether you're up money or down money at that moment. The viewer is locked in now not because of hype, but because of specific practice. Cal promise has been made, the 4-bar window will be shown, the decoder will be revealed, and in the next segment, the proof will arrive in the form of actual price action, actual examples, the kind of tangible evidence that separates charlatan advice from legitimate trading wisdom. This is the DNA of the opening. It establishes stakes, identity contrast, mystery, and promise all in one unified flow. Here's what Livermore discovered in the 1920s, sitting in bucket shops and brokerage offices with nothing but ticker tape, price movement, and time. The three things that never lie if you're willing to read them correctly. Real momentum, the kind that moves $500, not 5 cents. The kind that compounds into life-changing gains rather than noise that evaporates by market close. Always prints a signature. That signature takes exactly 4 candles to confirm, 4 specific price bars that telegraph intention before the real acceleration happens. Watch the pattern unfold in real time, because this is where the mystery resolves into mechanics. A stock gaps up on earnings, up 5% in the first 10 minutes of trading. That's bar 1 hope. It's retail traders buying the news, institutions buying the strength, amateurs piling in because they saw it on social media or heard it from a guru. Bar 2 arrives within the hour, or the next day depending on your time frame. Some profit-taking emerges. The early movers take chips off the table. Weak hands panic sell because they're afraid of giving back gains. But here's the signal that amateurs completely miss. Professionals start accumulating during this pullback. They're buying the dip. They're testing whether the move has real conviction or whether it was just a 1-bar emotion spike. Bar 3 follows, and the dip holds above the gap. This is crucial. The price rejects the downside. Support has been established. 5. Volume might tighten or stay steady, but the key observation is that sellers couldn't push it lower. Bar 4 arrives, and the close prints above all 3 previous highs. That close is the confirmation. That close is the pivotal point that Livermore lived and died by. That close is the moment when the tape stops whispering and starts screaming. Amateurs see bar 1, that gap up, and they buy on pure emotion, convinced they've spotted the next 10-bagger, terrified of missing out, entering with position sizes that reflect not their risk tolerance but their greed. They panic sell on bar 2 when they see red on their screen, when they feel the fear spike, when they imagine their unrealized gains evaporating. They never see bar 4 because they've already exited, locked in a loss, and moved on to the next chart chasing the next setup. The professional sees all 4 bars unfold. He waits through bar 1, resisting the urge to chase. He watches bar 2, noting where the dip holds. He observes bar 3, confirming that support is real. And on bar 4, when the close prints above all previous highs, he acts. Not with half his account, not with revenge trading capital. He acts with a calibrated, mechanical position size that reflects one thing: the confirmation of the pattern. Why exactly 4 bars and not 3 or 5 or 10? Because price has tested support twice by bar 4. Once implicitly on bar 1 when it rose and pulled back, and once explicitly on bar 3 when the dip actually occurred. By bar 4, short sellers have had 2 chances to step in and push lower, and they've failed both times. The rejection of the downside is no longer a maybe. It's a fact printed on the tape. The close on bar 4 with intention, meaning it closes in the upper half of the bar above all previous highs, tells you that buyers have seized control. Anything less than 4 bars is noise. EE bars could be a false breakout. 5 bars might mean you've already missed half the move. 4 bars is the minimum viable confirmation that the tape has spoken. 4 bars is the sweet spot where signal separates from noise, where hope transforms into probability, where amateur desperation transforms into professional conviction. Livermore watched the tape with one hand on the ticker, receiving updates every few seconds, and one eye on the 4-bar pattern emerging before him. When those 4 bars aligned, when the signature printed exactly as the tape dictated, he didn't hesitate, he didn't second guess, he didn't wait for one more bar to be absolutely sure. He pyramided, he sized up. He knew the odds had shifted in his favor because the tape had just confirmed it. The rule is non-negotiable until all 4 bars print. You're still in the setup phase. You're waiting. Your position size should reflect this truth: small or 0. You might size 1/10 of your normal position, or you might size nothing at all and just watch. Either way, the setup phase is a period of reduced conviction because the confirmation hasn't arrived yet. The moment bar 4 closes and the pattern completes, everything changes. You move from passenger to pilot. Your conviction becomes capital allocation. Your position size shifts from defensive to aggressive, from 1/10 sizing to 1-unit sizing, from tiptoeing to stepping. This is where amateurs lose money with brutal consistency. They size too big before confirmation arrives, betting the farm on a 2-bar setup that hasn't proven anything yet. They pyramid into incomplete patterns because they feel good, because the direction feels right, because their intuition is screaming at them to go all in. They confuse hope with probability. They confuse a partial pattern with a confirmed signal. The tape reads their desperation and punishes TH. It wicks them out on bar 3. It reverses on bar 4. It gaps against them on bar 5. A professional reads the tape and respects its rhythm. He understands that the 4-bar pattern isn't a suggestion. It's the market's way of communicating real control shifts. The 4-bar window isn't mystical or supernatural. It's not based on sacred geometry or Fibonacci or lunar cycles. It's mechanical. It works because enough market participants unconsciously follow the same rhythm, because price discovery happens in waves, because buyers and sellers take turns testing each other's conviction. It works because it filters out emotional noise, the panic selling, the FOMO buying, the headline-driven, whiplash, and locks in structural truth. It works because the pattern has been repeating for over a century across every market, in every time frame where it's been tested. The cost of ignoring this rule: 1 bad trade that wipes 3 good ones. You make $300 on 3 consecutive 4-bar confirms. You ignore the rule once, chase a 2-bar setup, and lose $1,000. Net result, negative $700 and a psychological wound that makes you hesitant on the next real setup. Respect the window because the window was built by real traders who survived real crashes, who built real wealth, who understood that markets reward discipline and punish desperation. The tape never lies, but amateurs never learn to read it. Here's where discipline breaks most traders, where the gap between knowing the rule and following the rule becomes a chasm that swallows accounts whole. They see bar 4 close. Confirmation arrives, the pattern is complete, and panic overtakes them. Not panic about losing, but panic about missing, panic about leaving money on the table, panic about not being aggressive enough in the moment when the odds have shifted. They panic buy with half their account, convinced that this is the moment to go all in, that hesitation is the enemy, that small position sizing is for cowards and doubt-riddled amateurs who don't understand conviction. They've just committed the cardinal sin that Livermore spent his entire career teaching traders to avoid: confusing confirmation with permission to go all in. Confirmation is not permission. Confirmation is the opening of a door, not the mandate to sprint through every door at full speed. Livermore's traders did the opposite of what modern traders do. Confirmation of the first 4 bars meant one thing and one thing only: buy 1 unit. Buy small. Buy with conviction, but buy small. The conviction came from seeing the pattern complete, from reading the tape and understanding that control had shifted to the buyer. But the position size reflected something different. It reflected respect for uncertainty, respect for the fact that even confirmed patterns fail sometimes, respect for the concept that you need to survive the failed setups to compound the winners. Then came the waiting, the watching for the next 4 bars. If those 4 bars repeated the pattern, if they held support, rejected selling pressure and closed higher, then you added 1 more unit. This is pyramiding. This is how you scale into winners without overexposing yourself on the first signal. This is how you compound a 2% move into a 20% gain without blowing you. P on a failed reversal that wicks you out and forces you to panic sell at the worst moment. An amateur sees 4 bars confirm, and his entire mental framework shifts instantly. All in, that's the thought that dominates. All in because the pattern is there, because the tape is spoken, because he feels the conviction in his gut. A professional sees those same 4 bars confirm and his thought is completely different. 1 unit. Then wait, that's it. 1 unit. Sized so that a reversal hurts but doesn't break him. Then he goes back to watching the tape for the next confirmation signal. The difference in outcomes between these 2 approaches is catastrophic. It's not marginal. It's not a matter of a few percentage points of return. It's the difference between accounts that survive crashes and accounts that evaporate. Consider a concrete example that Livermore himself would have tracked meticulously. A trader with a $10,000 account who sizes a single unit as $1,000 can add 4 times before his entire account is exposed. First confirmation arrives, he buys $1,000 worth. Bar 5 reverses, the pattern breaks. He's down $50 to $100 depending on where he exits. Manageable, survivable. He's still in the game. The same trader who sized $5,000 on bar 4 is down $5,000 on bar 5 and making panic decisions. He's in the red. His account is down. He's terrified. He's looking at his screen and seeing months of gains potentially evaporating. His emotion takes over. He sells at the worst moment, locks in the loss, and now he's damaged not just his capital but his psychology. He's broken the rule. He's proven to himself that he can't follow discipline when it matters. A professional never breaks the rule because the rule was built to survive his worst trading day, his worst drawdown, his worst streak. Of failed setups, Livermore kept position sizing so tight, so disciplined, that a failed 4-bar setup cost him less than his morning coffee. We're talking about losses measured in pennies relative to his account size. Losses that were so small they barely registered psychologically. Because of this discipline, catastrophic failures never happened. The kind of blow-up that wipes 90% of an account overnight became mathematically impossible. Slow ruin, the grinding death of 1,000 small losses, never happened either because each failure was contained so precisely. Instead, what happened was accumulation, day by day, lot by lot, winner after winner, each one sized small enough to survive the occasional failure, each one pyramided into with additional units, only after the pattern confirmed again. The protocol Livermore built and that his successful traders followed is deceptively simple. 1 unit on the first 4-bar confirmation. That's your entry. That's your signal that control is shifted and you have odds in your favor. 1 unit on the second 4-bar echo, meaning bars 5 through 8 repeat the pattern, and you add another unit because the conviction is now doubled. Never more than 3 units per move. Never. Not 4, not 5, not pyramiding all the way up to the top. 3 units maximum because at 3 units, you've got meaningful exposure but not reckless exposure. Enough skin in the game to make money, but not enough to destroy yourself if the move reverses. The tape doesn't care how confident you feel. The tape doesn't adjust its behavior based on your conviction level or your emotional state or how many times you've won in a row. The tape only cares about the pattern. It only cares about whether buyers or sellers have control. The tape is indifferent to your ego, indifferent to your desire to prove something, indifferent to your need to key back losses or lock in quick wins. Your job is to let the pattern size your conviction, not your ego. Your job is to respect the framework that the tape has provided and that Livermore codified over decades of watching price action. This is where the word professional earns its weight, where the distinction between amateurs and the people who actually make money becomes crystal clear. A professional isn't someone who trades more, or who has better instincts, or who can predict the future better than anyone else. A professional is someone who has the discipline to follow a rule that his ego despises. Someone who has the restraint to buy small when every fiber of his being wants to go all in. Someone who has the patience to pyramid across multiple confirmations, instead of dumping the entire account into bar 4. This discipline is what compounds wealth over decades. This discipline is what survives crashes. This discipline is what separates the traders who are still trading 20 years later from those who blew up in year 2. Now comes the counterintuitive part, the moment where the script flips and everything you've learned about aggression, about sizing up, about pyramiding with conviction, gets inverted into its opposite. The 4-bar window tells you when to buy, when to add, when to scale into winners with mechanical precision. But it also tells you when to do nothing, when to walk away, when to abandon the setup entirely and find another chart. This is the rule that amateurs refuse to learn because it violates every instinct they have, every emotional impulse that drives them to trade, every fear that whispers in their ear that if they're not trading, they're missing. Watch a chart long enough, and you'll see incomplete patterns everywhere. Bar 1 gaps up on news, on momentum, on FOMO. The opening is strong. Bar 2 consolidates, the initial buyers take profit. TS, the price stalls. Bar 3 pulls back, the dip tests the gap support. Buyers defend the level, but it's not the cleanest rejection you've ever seen. Bar 4 arrives, and here's where the pattern dies. It stalls. It closes only marginally above bar 3, maybe in the middle of the bar, maybe just barely above the previous close. The window didn't fully print. The signature didn't complete. The confirmation is incomplete. What do you do in that moment? Amateurs interpret a stalled bar 4 as almost confirmed, and they buy anyway, convinced that they're getting in early, that they're ahead of the crowd, that a close that's marginally above bar 3 is close enough to the real confirmation they've been taught to wait for. They rationalize it. They convince themselves that the pattern is 90% there, that waiting for bar 5 would be missing the move, that they should act on what they have. 1 month later, they're down 6% on a confirmed trade that never actually confirmed. That was a false signal the entire time. That was the market testing their discipline and finding them wanting. A professional sees that same stalled bar 4 and makes a completely different decision. He walks away. He finds another chart. He waits for the next opportunity. This is the hardest skill to teach because it feels passive. It feels like giving up. It feels like leaving money on the table. You're watching other traders pile in on the half-confirmed setup and making quick profits before it reverses. You're watching the price tick higher for the first few minutes and thinking to yourself, I should have bought that. You're watching other traders profit on a setup that you rejected and feeling the sting of missed opportunity. But here's the statistical truth that Livermore proved over and over again. The half-confirmed setup fails 4 times out of 10. That's a 40% failure rate. The full confirmation fails maybe 1 time out of 10. That's a 10% failure rate. The math is crude, but the direction is absolutely correct. The difference between a stalled bar 4 and a clean bar 4 is the difference between a 40% failure rate and a 10% failure rate. Over 100 trades, that's the difference between 40 losses and 10 losses, the difference between a negative account and a positive one, the difference between staying in the game and getting wiped out. Waiting is not missing. This is the mantra that separates professionals from everyone else. Waiting is discipline. Waiting is the active choice to preserve capital, to refuse a setup that hasn't met your standard, to acknowledge that the tape hasn't fully spoken yet. Livermore used to say something that became legendary among his students and the traders who studied him obsessively. He made more money by sitting in his office doing nothing than by trading. He wasn't bragging about his discipline or trying to sound wise. He meant it literally. He calculated it. He tracked it. The days he didn't trade were days he didn't get punished for half signals. The days he didn't trade were days he didn't override his rules because of impatience. The days he didn't trade were days when no 4-bar confirmation appeared that met his standard, so he did nothing, and that nothing, that disciplined refusal to trade, made him more money than the trades he actually placed on mediocre setups. The 4-bar rule is a filter, nothing more and nothing less. It filters out noise. It filters out hope. It filters out the FOMO trades, the revenge trades, the I need to make money today trades. It leaves only the signal strong enough to trust, only the pattern that is truly confirmed, only the moment when control has genuinely shifted from seller to buyer. If bar 4 doesn't fully confirm, if the close is marginal instead of decisive, if the bar stalls instead of closes with intention, then the signal isn't ready. Your job is to walk away and find the next one. There will always be another chart. There will always be another setup. The market generates thousands of trades every single day across every time frame and every instrument. A trader who has the discipline to walk away from incomplete patterns will see more complete patterns than a trader who trades everything that looks remotely promising. This takes mental steel. This takes the ability to sit on your hands while others are making money. This takes the psychological strength to say no to your own urge to trade. Amateurs don't have it. They can't sit still. They can't watch a half-confirmed setup without feeling compelled to join. Professionals do have it because they understand that compulsion is the enemy. They understand that the traders who make the most money are the ones who trade the least, who have the discipline to trade only when the odds are genuinely in their favor. The paradox is this, and it's the most important paradox in all of trading. The more you respect the 4-bar window, the less you trade. The less you trade, the higher your win rate climbs, because you're only trading the signals that actually work. The higher your win rate climbs, the more capital you accumulate, because each winning trade compounds the previous one. The more capital you accumulate, the larger your position sizes become on the same 4-bar confirmations, and the exponential growth accelerates. This is compounding at its purest form, at its most elegant, This is how Livermore turned speculative trading into wealth accumulation. One perfect trade beats 10 mediocre ones. One complete 4-bar confirmation beats 10 half-confirmed setups. Wait for perfect. Wait for the close that's decisive. Wait for the rejection that's clean. Wait for the 4-bar window to fully print. And when it does, when the tape finally speaks clearly, then act with conviction. The 4 bars don't exist in isolation, floating in some abstract mathematical space divorced from reality and market structure. They're part of a larger tape, the continuous conversation between buyers and sellers, the daily negotiation over price, the moment-by-moment communication of supply and demand. Livermore's genius, the thing that separated him from every other trader of his era and most traders today, was that he could see the conversation in real time and predict the next speaker before they even opened their mouth. He could read the tape like a musician reads a score, understanding not just the notes, but the intention behind them, the emotion, the conviction, the shift in control. Here's exactly how that works and what you need to watch for. On bar 1, the moment the gap up appears or the initial move prints, watch the volume. This is the critical first observation. A gap up on thin volume is amateur buying, emotional buying, panic buying from retail traders who saw the news or heard the story and felt compelled to participate. Volume tells you the story of who's behind the move. A gap up on heavy volume tells a completely different story. It's smart money accumulating, institutions stepping in, professionals piling in with real conviction and real capital. The volume signature on bar 1 is your first clue about whether this move has institutional backing, or whether it's just emotion waiting to reverse. Bar 2 arrives, and here's what you're watching for: the pullback and its volume characteristics. If the pullback is steep, meaning price gives back significant portions of bar 1's gains, and that pullback happens on light volume, what does that tell you? It tells you that buyers are patient. They're not dumping. They're not panicking on the reversal. They're accumulating more on the dip. The light volume on the pullback reveals buyer conviction. Bar 3, if the dip holds near the gap level, if support is genuine, and volume again tightens, the buyers are clearly in control. You're watching a battle, and the buyers are winning every skirmish. Bar 4 arrives and the close prints above all previous highs, and here's the thing that most traders miss. It doesn't matter if that final close happens on light volume or heavy volume. The close itself, above all previous highs, tells you that the tape has spoken decisively. Buyers won. The tape has a rhythm, a cadence, a structure that repeats across decades of market history. Amateurs miss it completely because they're watching indicators instead of watching price. They're watching moving averages that smooth price action and lag reality by 1 to 3 bars. They're watching oscillators like RSI or stochastic that peak and trough after the real move has already happened. They're watching MACD crossovers and Bollinger Band bounces and every other lagging indicator that was invented to help traders who couldn't read the tape. Professionals ignore the lagging indicators entirely, dismiss them completely, and focus exclusively on what the tape itself is telling them. Volume, price, time, that's the language of the tape. That's the only vocabulary that matters. A 4-bar pattern printed on heavy volume from bar 1, where the buyers came in with conviction and never let up, says something fundamentally different than the identical 4-bar pattern printed on light volume, where the buyers trickled in gradually. A 4-bar close above previous resistance with a wick back into bar 2, meaning the bar tested higher than pulled back before closing at the highs, is telling a story about some resistance to the move, some S. Ellers testing the level, but ultimate buyer control. A 4-bar close at the highs with no wick, a clean drive to new territory with no pullback intrabar, is a different story entirely. It's pure buyer conviction, no hesitation, no testing of resistance. The stories tell you something critical about the strength of conviction behind the move. Livermore called this entire process reading between the lines. You're not predicting where price is going next. You're not forecasting. You're observing what's already happened, what the tape is already showing you, what the buyers and sellers have already communicated through their actions. You're letting the tape show you who has control at any given moment. The moment control shifts decisively to the buyer, you act and size appropriately. The moment control shifts back to the seller, when bars 5 through 8 stop confirming the pattern, when volume dries up, when the tape changes its story, you exit without attachment, without regret, without wondering if you should have held. The 4 bars are the first chapter of the story, the opening act that sets up everything that comes next. Your job as a reader of the tape is to listen for the next chapters, If Chapter 2, which is bars 5 through 8, repeats the pattern, if it holds support, rejects selling, and closes higher, then you're not wrong about the move. The story is confirming. The tape is speaking the same language. But if Chapter 2 breaks the pattern, if bars 5 through 8 fail to repeat what bars 1 through 4 showed you, then the tape was lying. Not maliciously. The tape never lies about what happened. But the implications you drew, that control had shifted, that conviction was there, were premature. The story changed. The tape is now showing you a different narrative. You need to exit because the reason you were in the trade no longer applies. Why professionals don't get emotionally attached to trades the way amateurs do. They don't fall in love with positions. They don't hold losers hoping for reversals. They don't become invested in being right about a particular trade. They're just reading a story. They're observers, not participants in the outcome. When the story is good, they're in. When the story changes, the reader moves on to the next book, to the next chart, to the next tape that's printing a clearer narrative. This detachment, this ability to hold a position with full conviction one moment and exit it completely the next moment because the story changed, is the fifth pillar of mastery. It's the psychological skill that separates traders who last decades from traders who blow up in their first bear market. It's the difference between someone who trades and someone who is a trader. Now you know the 4-bar rule in its mechanical form, the pattern that prints on every chart, the signature that real momentum leaves behind before acceleration. You know the sizing protocol, the discipline of 1 unit on the first confirmation and 1 unit on the second echo, never more than 3 units per move, the guardrail that prevents ruin. You know when to wait, when the bar forestalls and the confirmation is incomplete, when walking away is the most profitable decision you can make. You know how to read the tape, how volume and price action within each bar tells you a story about conviction, how the 4-bar pattern is only the opening chapter of a larger narrative that continues through bars 5 through 8 and beyond. You now possess the framework, the tools, the mechanical rules that separate traders who last from traders who disappear. But here's the brutal truth that no amount of knowledge can teach. What separates the top 1% from the rest? What separates the traders who compound wealth for DE? Cades from those who blow up in 3 years isn't any of those things alone. It's none of the technical knowledge, none of the pattern recognition, none of the tape reading skills. It's the discipline to follow the rule when it doesn't feel right, when every instinct in your body is screaming at you to do something different. You'll see a 4-bar pattern confirm. The bar 4 closes exactly as you have been taught to expect. The tape has spoken. The signal is clear. And your gut will scream at you, this is the one. This is different. This feels big. Go all in. This time is different. Your intuition is roaring. Your confidence is spiking. You can feel it in your body. This one is going to move. You know it. Every fiber of your being wants to go all in, to bet the farm, to finally make the big trade that changes everything. Discipline says no. 1 unit. That's it. 1 unit. Not because the pattern isn't there. Not because you don't have conviction. You have conviction. The tape showed you the pattern. But discipline says 1 unit, then wait and see if the next 4 bars confirm. You'll see a stalled bar 4, a pattern that didn't fully confirm, a close that was marginal instead of decisive. And you'll think, I missed this one. I was being too strict. Look at it moving. I should chase it. I know the pattern. I can still get in on this move. The fear of missing out is roaring. The regret of being too disciplined is screaming. Everyone else seems to be making money on this setup. You're sitting on the sidelines. Discipline says no, wait for the next. Not because this one won't work. Maybe it will. But the odds aren't in your favor and you know it. You'll see your winner hit 5%, a move that confirms your thesis, a trade that's working. And you'll think, let it run. Let me hold this. This could be a 20% move. I should be patient. The greed is wry. Sing. The victory is making you confident. You're imagining the additional profits that might come. But discipline says, check the tape. Is the pattern still there? Are bars 5 through 8 still repeating what bars 1 through 4 showed you? If yes, hold. If no, exit. Exit with your 5% gain rather than holding for greed and watching it reverse and give back 3%. This is the discipline that separates professionals from everyone else. Amateurs confuse intuition with discipline. They think feeling confident is the same as having a rule. They think their gut instinct, their pattern recognition, their intuition about the market is equivalent to disciplined rule following. It isn't. A rule works when you feel terrified, when you're down money, when you're questioning everything, when doubt is the dominant emotion in your mind. In those moments, when fear is loudest, when panic is closest, when you want to break the rule and chase a reversal or hold a loser, hoping it comes back, that's when a rule earns its value. That's when it saves your account. A rule works when you're down money and doubt everything, when your confidence has been shattered by 3 losses in a row, when you're wondering if you ever understood the market at all. That's when a professional trusts the tape. That's when he doesn't double down on revenge trades. That's when he sizes small and waits for a clean confirmation. That's when he compounds, slowly, methodically, without drama. The 4-bar momentum hack isn't complicated. It's not sophisticated. It's not a secret algorithm or a proprietary indicator or something that only geniuses can understand. It's mechanical. Bar 1 through 4. Wait for confirmation. Don't trade before the pattern completes. Don't trade on hope or intuition. Wait. Bar 5 through 8. Pyramid if the pattern echoes. The first confirmation gave you odds in your favor. The second confirmation doubled down on those odds. Add 1 more unit. Bar 9 and beyond. Respect the tape or exit. If the pattern breaks, if the story changes, if the tape is no longer confirming what it confirmed before, get out. Exit without regret. Find the next setup. This is how Livermore turned speculation, which is just educated guessing, into science, into repeatable mechanical process, into something that could survive market crashes and personal hardship. This is how he survived the crashes of 1929 and beyond. This is how he won, decade after decade, across different market conditions, different volatility environments, different eras. The final edge isn't being smarter than anyone else. The top 1% aren't smarter. They don't have better instincts. They don't predict the future better. The final edge is committing to rules that 99% of traders refuse to follow because those rules feel too constricting, too mechanical, too divorced from the excitement that draws people to trading. The 99% feel constrained by rules. They need excitement. They need action. They need to feel like they're doing something, making decisions, proving their skill. They get wiped out. The 1% follow the tape. They wait patiently for the confirmation. They size small on the first signal. They pyramid methodically across multiple confirmations. They exit without attachment when the story changes. They compound, year after year, decade after decade. You now know the rule. You now know the framework. You now know exactly what separates the traders who make money from those who don't. The knowledge is in your possession. It costs you nothing. It's free. But knowledge is worthless without execution. The question that matters now is simple, and it's the only question that will determine your future as a trader. Which one per cent are you? Are you the one who will follow the rule when it doesn't feel right? Are you the one who will size small when every instinct screams to go all in? Are you the one who will walk away from incomplete patterns and wait for the next clear signal? Or are you the 99%? The choice is yours. The tape is waiting.